got Vikas Khemani as well from Carnelian Capital and welcome him on the show right now. Vikas, hi, morning. Not really turning out to be the best of mornings. As swift the recovery from June lows was all the way to almost 18K, similarly as swift seems to be the decline now. But the only thing, Vikas, is that we're not alone in this current weakness. It's pretty much a global phenomena and we seem to be aligning ourselves with the likes of the Dow as well as the Nasdaq. Having said that, where do you think the market fall is going to arrest itself, and why is it that the market is giving up gains the way it is?
So I think we recovered based on there was a time when there was extreme pessimism, and as the Fed rate kind of were behind and commodity prices started cooling off, you saw a pullback in the market. But still the effects of interest rates is not fully behind. Still, the quantitative withdrawal is going to begin, or has just begun in this month in a meaningful manner, which is going to continue. So I think while commodity pricing settling down across the globe definitely has huge amount of sort of comforting effect, but still the money withdrawal will have to play out over next few quarters, and we'll have to see what's the impact of that in general. So I think we saw a good pullback, and now I think markets are kind of sort of you're seeing again maybe profit booking, or maybe the what is the Fed's next move. There's a hypothesis also building in the market that probably Fed could be a little bit more aggressive given the kind of job employment numbers are coming in US. So now again, so till the time we hear from Fed, you will see this kind of environment happening. So this is a part of the normal, I guess, cycle. The fact of the matter is that right now the whole sort of world is whether the developed markets are going into recession or not. What is going to be the pace of deceleration and the growth? That is where the narrative is. That is where the lot of things are going to be key determining factor, and that picture is only going to be known in the future. And markets will keep playing, in that range, so to say, till the time we see that clarity.
Because I was just going through a couple of notes, and I believe you've come out with a Carnelian shift strategy. I wanted to probe a little bit more about that because I'm sure all our retail viewers also would be interested in this. What does this shift mean? I mean, because, we've frankly seen a lot of sectoral rotation as well, right from the recovery to the June lows to what's falling maximum right now. So what is this shift strategy all about?
So this is, clearly focusing more from a decadal perspective. We saw post-pandemic two very major shifts happening, in the Indian economy, which is going to create massive amount of wealth over the next, 5, 7, 10 years. And one of them being is manufacturing. We think manufacturing, where China was in 2003, 4, India is probably beginning to see that kind of trend, led by Atmanirbhar Bharat's focus of the government to make India self-reliant on the manufacturing, because that is our biggest vulnerability. And also second big trigger where China plus one is playing out. So there's massive amount of opportunities which is getting created in the manufacturing space. And as we see this pan out, because manufacturing does not pan out overnight, it requires investment, it requires capex cycle. So we think our manufacturing GDP will double over next 5-6 years from $450 billion to $1 trillion. And this kind of growth, whenever it comes in any sector, it creates massive investment opportunities, and that is what we are sort of aiming at. And there are many sort of reasons why this time around the probability of this happening out is far more positive than it has ever been in the past. So we see this as a very big structural trend, and that's likely to play out. And second shift, which we talked about, that every company globally, locally, is forced to spend a lot more money on the technology than they have ever spent. And so that also is going to see acceleration. Of course, right now on that front, there's a little bit of nervousness around given what's happening in the US demand environment. So that might slow down in a shorter term, but which is fine. But what we are talking about is a 5-10 year trend where the spend on these tools is going to kind of increase, and these are the structural opportunity. And I've seen many companies in the manufacturing space. We feel that will become future, multi-baggers, future leaders. That today they are tiny. So if you see in IT space also in mid 90s, you saw many companies which were small became large over 10 years. Similar kind of trend can happen in manufacturing, because this is once in a sort of decade kind of opportunity, And fortunately, it appears that most of the stars are aligned for this to make happen.
Right. So, manufacturing is a big sector. How would you want to play it? Would you want to play it like power transmission, cap goods like Siemens ABB, or, something like a manufacturing company which recently got listed, which makes phones, TVs. How would you essentially play this manufacturing theme or a mix of all?
Yes, absolutely. So I think here the key idea is to invest into sectors where either there's import substitution happening or there is a sort of export opportunity or a combination of both happening. So I think very obviously there are 6 or 7 segments where this is a massive sort of opportunity. One being chemicals, specialty chemicals, where of course we have seen already some things moving out. Auto components is a space where India has a unique advantage, and from a cost competitiveness perspective, capability perspective, where India can do very well. Textiles and specifically garments, another segment where China has 35% market share, India can gain its own. Given our labor costs are far more lower than China, we have advantage and we can kind of gain very large position in there. Defense related stuff, we see massive amount of focus again on both import substitution and export. That continues to play. So like this, there are many segments which are sort of building, and building materials is another one where you will see capex related. Capex has begun, and capital goods is a very another sub segment where we can see great opportunity. So if you see each of them, and each of them have their own nuances. So but the underlying theme is the investments in the manufacturing opportunity in the manufacturing, both from an import substitution as well as export perspective. When we talk to companies, companies tell us that we have never seen this kind of export demand environment, in our lifetimes. Now, when you see this kind of thing, you figure out that something is changing globally, and I think this will play out over next 3, 4, 5, 7 years period, and that is what whole idea is to identify good quality companies which are well placed in this sort of tailwind or emerging theme and across various sub-segments which I spoke about, and remain invested for a long period of time.
Right, remain invested for a long period of time and let the theme play out. That's essentially the theme that Vikas is talking about. Vikas, how would you look at what's happening with some of the manufacturing ancillary companies? So whenever we've earlier told you we want to play capex, you will say I'll play with it via building materials, I'll play it via cement companies. Is there any such sector within manufacturing?
No, I mean, like I said, that capital goods is again a very large sector. When you play the investment cycle, you can play that out. Regarding your question was more of in infrastructure ancillary, or sorry, I didn't get your question.
Ancillaries. How is that the way to play? Whether you want to play manufacturing, cement, how should one play that?
So again, there are companies. So if the investment is happening on those cycles, there are companies which are aligned to the investment cycle on those sectors. So let's say we would not play sugar sector, but we can play sugar because there's a lot of investments happening. So we can play a sugar capex company, right? Same way, so you can in the steel cycle when the investment is happening, you can play on the capex place in the steel cycle because the capex cycle has begun in those respective sectors. So if you don't want to play directly some of the sectors because of their own peculiarities, you go and tend to play to the ancillary which will benefit from those sectors, and they are also less prone to the vulnerabilities of the mainstay companies.
Vikas, always so good to have you on the show. Thanks for taking the time out and joining in today.